Ultimately, when you're looking at a PPM, you should look at ultimately how they intend on doing it. Are they going to do a straight split, 80-20, if that's the deal, and the sponsors are going to get 20% of all losses? Is it going to go risk of loss, meaning that people that capitalize the deal are going to get losses until they have no more capital in the deal? And then make sure that that is memorialized in an operating agreement.
All right, ladies and gentlemen, welcome. We are going to be running through some basic tax questions here with our CPA, Tim Gertz. Tim, thanks for being on with us today.
Anytime.
So, Mike, you're here with me today, too. We're going to have a little bit more of a conversational type podcast episode here. Talking first about income categories. How does the IRS treat the associated tax treatments with active income versus portfolio income versus passive income?
So they're all individualized. So when you think of an active income is something that you actually materially participate in. So think of, you have a job, you get wages. That's something you actively participate in. You're a real estate agent, you sell properties, you're active in that sale, you get a commission. Active income is ordinary income. So it's taxed at ordinary income tax rates, but it's also subject to self-employment tax. So that's FICA and Medicare. So that's the difference with active income. Active income is taxed at ordinary income rates. It's subject to self-employment tax, either through wages, withholding there, or self-employment tax when you file your own tax return. Portfolio income is preferential. Portfolio income, when you think of that, you think of capital gains. That's the largest chunk of a portfolio income, and it's taxed at its own tax rate. So if you got long-term capital gains rates, it's taxed at 20%. If it's a bullion or something of that nature, it might be taxed at 25%, but it has its own tax rate. And then the last is passive. Passive is also ordinary income. It's taxed at ordinary income tax rates, but it is not subject to self-employment tax because you are passive or you don't materially participate in that activity. So those are the three kind of buckets of income. The one thing to remember with those three individualized buckets is they really only can be offset by income or losses within that bucket. So capital losses can only offset capital gains. Passive losses can only offset passive gains. The difference, ordinary losses can offset anything. So active income can be offset by active losses, but active losses can actually offset every other income category that's out there. So that's the one big thing. And that's why when you talk to a lot of people, they're always chasing active losses, being a real estate professional or something of that nature, because it can offset any other income.
And what would be an example of an active loss?
You operate a business and it's capital intensive business. So you buy a lot of equipment and you depreciate that equipment and have a loss. Or you're a real estate professional and you buy a piece of property that has a large loss through depreciation.
Okay. So if you're buying something for the business that you can write off, that would be active losses.
Correct.
Got it. And that will offset your active income.
It will offset active income. It'll offset portfolio income. And it'll offset passive income. That is, when you think about the three different buckets, I tend to call it a waterfall. And active income is the top of the waterfall. And so once it's offset all the active income, it falls down to the next level and then the next level. And so passive income is the bottom. That bucket is the bottom of the waterfall. And so passive losses offset passive income. But since they're at the bottom, they can't offset anything else. They just carry over to the next year.
Got it. So another kind of perspective, let's say I have a job, I have W-2 income, and I invest in real estate passively. Is there a way for me to offset my active income with the real estate investment, or is that not going to fly?
If you have a wife or a spouse that is a real estate professional, yes. But you personally typically cannot do that if you're a full-time employee, because you have to do real estate more than your active job.
And a wife, so if she is a real estate professional and she qualifies and you're married, now you can qualify for passive losses.
You can take that passive loss and convert it to an active loss.
Okay.
Because she's active in real estate.
Let's talk a little bit more about classifications. So you have your real estate professional, you have an active investor, you have a passive investor. What are the differences between each and how are they accounted for differently?
So a real estate professional, so what you have to think about is, as an active in a trader business means that you materially participate in that trader business. A real estate professional is someone that is actively involved in that trader business of real estate. And so a real estate professional is someone that spends more than 750 hours in real estate related activities and does that more than any other income producing activity. And so what that does is, if you hit those two hurdles, well, now you're a real estate professional for tax purposes. And what that does is it converts something that was inherently passive. Rental real estate is inherently passive. It's not considered a trader business in the tax law, into a trader business. And then now we have to look, are you active in that trader business?
Are you saying trader business or trigger business? What was that, Tim?
Trade or business.
Trade or business. Thank you.
And so ultimately, if you are active in that trader business, then losses and income from that trader business can offset each other actively, other active income, any other income that you might have. So that's the big caveat with a real estate professional and why people are trying to get to that level. Being an active investor in a real estate deal or owning rental real estate, there's what they call mom or pop business. So the way you want to think about it is, you are a husband and wife, you own your house in Minnesota, you retire, you move to Florida. You don't want to sell that house in Minnesota, you rent that house out. You're actively involved in that rental real estate. So you manage it, you do the leases, you talk to the people, you're basically the landlord and you're actively involved in that. That is an active involvement in rental real estate. That gives you the ability to potentially take $25,000 in losses from that rental real estate against any other income. There are some caveats to it, income limitations, things of that nature, but that is what an active investor in rental real estate is. The last is a passive investor in rental real estate, or a limited partner in most cases. Those are people that have no involvement. They don't rise to the level of material participation. They are not a real estate professional. They are just a passive investor. That income will always be passive. Losses will always be passive, and will never be able to offset anything else as long as that investment is active or ongoing.
With being an active investor and trying to qualify as a real estate professional, if you are a realtor and you sell homes, does that qualify as an active investor, or do you have to own it and be managing deals to try to get those hours?
So again, there's two levels. You have to be a real estate professional, and then you have to materially participate in that activity. So being a real estate agent will rise you to the level of being a real estate professional, because that's a real estate related activity. So you do have the ability to be a real estate professional as a realtor, as a property manager, as a construction, as a GC. Any of those will qualify you as a real estate professional. But then ultimately you have to look at the deal, and are you materially participating in that deal? So do you do all the work? Do you spend more than 100 hours in that deal and do more than anyone else? Or do you spend more than 500 hours in that deal? And so now you're a real estate professional as a realtor or a real estate agent, but you're not materially participating in that investment, and therefore you still are passive. So you can be a real estate professional and be passive in deals.
Got it. And it sounds like if you have a W-2 job, you're working full time, even if you are actively involved in real estate, a significant amount, it'd be pretty tough to be considered a real estate professional, because you have to stick in more than 40 hours a week into that real estate career. Is that correct?
Exactly. I mean, I always use myself as an example. I'm, adamantly involved in real estate. I love real estate. I, spend tons of time analyzing, looking at deals, things of that nature, but I spend 2,500 hours a year at Provision. There's no way I spend more than that doing real estate related activities.
All right. What is a K-1 and why is it issued to an investor?
There's taxpayers, and then there's flow through entities. taxpayers are individuals, taxpayers could be trusts, taxpayers are C corporations. So essentially, those are people that pay tax at that level. So if you have a C corporation like GM pays tax at their corporate level. If you have a trust that, could potentially pay tax at the trust level, individuals pay tax at their level. Flow through entities, which are partnerships, S corporations, disregarded entities, flow that income through to a taxpayer that ultimately pays the tax on that income. So in order to ultimately flow that income through, it has to be reported on some sort of form. And that's what a K1 is. All a K1 does is it allocates the percentage of your ownership in that income, in that loss, in whatever it might be, to you so you can report it appropriately on your personal return.
Got it. So when we kick out K1s to investors, what should the investor be doing with that K1?
If they're preparing their own tax returns, they should be utilizing it to prepare their returns, or they should be providing it to their tax preparer.
Gotcha. And the tax preparer will take the K1 and apply it to their setting.
Correct. It has all the information that they will need. It will have all the information, whether or not they have basis to take losses, anything for any of the calculations that are needed at the individual level.
Great. Thank you.
Tim, can you give an overview on what a cost segregation study is and why it's beneficial?
When you think of real estate includes not only real property, so land and the building, but it also includes short-lived assets, what are called personal property. So, behind you, Mike, you've got cabinets, you've got equipment, you don't have window coverings, but things of that nature, ultimately, which is considered short-lived tangible property. And so all a cost segregation study does is it goes into a piece of real estate and it says, this is what is 5-year assets. This is what is 15 years assets. This is what is 27.5-year assets. And it segregates that out. And why that's beneficial is the depreciation code is different based on the class life of that asset. So if it's residential real estate and we don't do a cost segregation study, we have to take that at 27.5 years straight line. So we take, $1 million property, we divide it by 27.5, and that's our annual depreciation. If we do a cost segregation study, now we get to look at, well, here's a 5-year asset. Well, 5-year assets qualify for bonus depreciation. They qualify for a accelerated depreciation if we don't take bonus. So now not only are we able to speed up the deduction of that asset, but we can decide, do we want to take bonus? Do we not want to take bonus depreciation? Do we want to take it double declining? Do we want to take it 150 declining? It just gives us the opportunity to plan appropriately. And so that's why a cost segregation study is so powerful, because without it, our only option is 27.5 years if it's residential real estate. Where did
27.5 years ever come from? Why is that the number?
I mean, it really, you think about it, it doesn't make a lot of sense. Why is residential rental real estate 27.5 years, and why is corporate real estate or commercial real estate 39 years? Like, why is there that big differentiation? Why are land improvements 15 years? I mean, it just doesn't make sense. And anyone that's in the residential rental space understands that a lot of the stuff that they say are 5 and 7 years, every time you turn an apartment, you have to replace it. So, why is this a 5-year asset when if it's a 12-month term or 24-month term, you're going to have to go in and replace or do this or do that. So who knows? Someone in a back room decided that that's what it was.
Got it. And Tim, what type of questions should an investor ask their general partnership team when investing in a deal pertaining to cost segregation studies and bonus depreciation?
I mean, number one, are they doing it? What is their outlook on it? Ultimately, every cost segregation, any reputable firm that's doing a cost segregation study has to follow the same, guidelines that that their brother or sister firm is doing the same thing. So really, just, are they doing it? What do they expect the outcome of that cost segregation study to look like? Are they going to take bonus depreciation? Really things of that nature.
And is it important to decipher how they're allocating the depreciation losses as well?
Yes. I mean, ultimately, when you're looking at a PPM, you should look at ultimately how they intend on doing it. Are they going to do a straight split, 80-20, if that's the deal, and the sponsors are going to get 20% of all losses? Is it going to go risk of loss, meaning that people that capitalize the deal are going to get losses until they have no more capital in the deal? And then make sure that that is memorialized in an operating agreement. So the operating agreement is law. PPM is just how we intend on doing the deal, and here's our CYAs per SEC requirements. But the operating agreement is true law, and as a CPA, the tax law specifically says I have to follow the operating agreement. So you want to make sure that the operating agreement says what you thought the deal was, and if it doesn't, then I would question it. A lot of times what we see that people invest in deals, and then when they don't get what they thought they were supposed to get, they question us. Why does my K1 look like this? Why doesn't it look like that? And a lot of times it really does, unfortunately, fall down to a lot of people use CPAs that don't understand or actually read operating agreements as they should. So
I've noticed, through the CPAs I've worked with and through a lot of our investors, the questions we get from our investors, most of the CPAs don't really understand cost segregation and K1s, and they don't really know how to apply them. So if you're an investor, maybe you want to be looking at finding a different CPA or interview some CPAs just to make sure they're real estate savvy and can give you the best tax advice. You might pay a little more, but the savings may be significant on the back end.
correct. There's been, countless times when I've received a K1 and said, this isn't accurate, and actually have gone back to the sponsor and had the return amended to correct that based on what the operating agreement should have said, it should have followed.
Yeah, what are the differences of using bonus depreciation over a 1031 exchange? And as the depreciation is sunsetting, do you think we'll see more 1031 exchanges happening moving forward?
So the difference is bonus depreciation is immediate expensing. So there's no real restrictions in what we do with that, other than if we're going to depreciate one asset that is a 5-year class life, we have to bonus depreciate the other assets that are 5 years. So we elect in or elect out, but it has to be over the entire life. But what that does is that gives us the ability to plan and be unrestricted in how we plan with bonus depreciation. Because if I've got $100,000 gain and I want to offset that, maybe I only want to offset $60,000 of it. Maybe I want to use $40,000 and invest in stocks or bonds or whatever it might be. Well, I can do that through bonus depreciation because I can look at how much do I need to invest in this deal and what is that bonus depreciation going to be. With the 1031 exchange, it's much more rigid. Well, I get $1 out of a deal, I have to put $1 into a new deal. If I don't put that $1 into that new deal, it's tax first, basis second. So if I have 100, I always use the example, you own a property for 30 years, you paid off the mortgage, you have 100% cash deal, you sell that deal, maybe you only have a 80% gain. Well, if you don't put 100% of that deal into a new deal, you're going to pay tax on that 20% you took out. There's no way to get around that. So it's restrictive in that way. And it's also restrictive in that you've got timelines. You've got to hit a 45-day identification period, got to hit a 6-month close. And a lot of times the third-party intermediaries, the exchangers, will hold your cash for 6 months and a day. So if you blow that 1031 exchange, you might still have to wait 6 months to get your cash back. So it's much more restrictive. It's much more cumbersome, and it doesn't give you a lot of ability to plan.
Yeah, when you just said taxed first, basis second, what is basis? How can you describe basis in layman's term?
It's taxed money. So ultimately, you have $1, you invest in a deal. That $1 essentially is usually taxed. It's money that you've already paid tax on. So that's basis, meaning if I put $1 into a deal and I get $1 out, I don't pay tax on that $1 I get out because it was basis that I put in. Now, if I put $1 in and I get $2 out, then I'm going to pay $1 of gain on that dollar I got out above my basis of $1.
Got it.
And in a 1031 exchange, you think of it as the froth, and the basis is the liquid. And so ultimately you're going to, if you're taking anything out of that cup, it's froth first. So ultimately you're going to pay tax on that froth. And then once you get below the froth, then it's going to be basis. So it's a little bit more restrictive in that you're essentially paying tax first on any dollar you take out of a 1031 exchange.
When does bonus depreciation phase out?
Bonus depreciation is falling off. As of 2026, it will be gone. So I do think in the 1031 exchange realm, you will see that people will start doing more and more 1031 exchanges because at that point, it will be beneficial for deferring tax. So really with bonus depreciation, all we're doing is we're deferring tax. We're just deferring tax how we want to defer tax. We're kicking it down the curve, we're kicking that tax deferral down the road each time we sell a property, reinvest in a property that's going to give us a bonus depreciation loss. We're just doing what a 1031 exchange is doing. We're just doing it using the current tax law. So as that bonus depreciation starts to phase out, 1031 exchanges become more and more prevalent. Before bonus depreciation in real estate, we would do cost segregation studies like we do now, but we have the ability to put those in service when we want to put those in service. So we can do a cost segregation study today and put it in service 7 years from now. And so what we were doing back then is we were doing cost segregation studies on properties that had already been in service in years of immense gain. So you've got 10 properties, you sell a property in year 7 that has $1 million gain. We do a cost segregation study on properties that are already in service, and we pull all the depreciation we would have gotten if we put that depreciation in service in day one into the day we put that cost segregation study into service. So it was giving us the ability to basically do what bonus depreciation is doing now, just more strategically.
What happens to depreciation losses if an investor is using a retirement account, such as an IRA or a solo 401k?
They're still there. They're just not available to be utilized to offset other outside income. So, I mean, again, that is a taxpayer. So it's considered a trust. An IRA is considered its own individual taxpayer. It has tax if there's UBIT or unrelated business income tax that is triggered by debt. So on a piece of real estate, if you have debt, income related to that debt is taxable. And so there is the opportunity to basically be able to do the same thing that we're doing outside of a retirement account inside the retirement account. So there's misnomer that IRAs don't need depreciation and IRAs don't need, to use bonus depreciation. But there's an opportunity if you've got a large sale and you're going to pay UBIT tax, which is 37%. It's the largest tax out there, and it goes from 0 to 100 after $12,500 of income. So if you have more than $12,500 of UBIT income, you're paying tax at 37%. So ultimately, you want to be able to reduce that as much as possible. So the use of depreciation and things of that nature do fall into it. Now, depreciation within a trust, they don't have the access of bonus. They have to use straight line, but still, depreciation is utilized within an IRA account.
Got it. Very interesting. So let's say you invest $200,000 into a deal through a self-directed IRA, and you get $100,000 in depreciation losses year one. And maybe the following year, you have $25,000 of income on the K1. You're able to offset that so you don't have to pay the UBIT by using that depreciation loss that you saw year one of ownership that carried forward, correct?
You would ultimately have to memorialize that. So one of the things that doesn't happen a lot is people don't file tax returns for IRAs. They're 990Ts is what they're called. So as long as you're following and you're filing, then you can utilize that to offset other income. But yes, essentially the character is the same within that taxpayer. Like I said, it's an individual taxpayer. So it's just getting flow through income or losses that it's going to treat within its own tax return accordingly.
Okay. And what's the difference in between a self-directed IRA and a solo 401k?
Different tax codes. So a self-directed IRA is under 403. There's different 403, 408, 401. Anything that is outside of 401k is subject to UDFI, which is unrelated debt financed income. So ultimately, if you have a gain, you're an LP in one of your deals that's financed 80%, let's just say, and you throw off $1 million of gain. Well, 80% of that gain came from debt. So 80% of that gain is going to be subject to UBIT tax because of UDFI. If that was in a 401k, that wouldn't be the case because 401ks aren't subject to UDFI. So the difference there is in that situation, a 401 is no tax. An IRA is taxed at 37% on 80% of that gain.
Got it. And in order to set up a solo 401k, that's essentially a 401k for a business, correct? So you have to operate some sort of business.
Correct. That's the big caveat is a 401k is owned by the business and an IRA is an individual retirement arrangement. So it's individual.
So if an LP invests 100 grand and gets 50,000 in losses, what does that mean for the investor? Is there going to be a difference based off of you being an ordinary earner, portfolio income earner, and passive income earner?
Yes. So ultimately, if you're a real estate professional and that is part of your portfolio that you are actively involved in, that $50,000 of loss can be utilized to offset $50,000 of active income. So W-2 earnings, income from an active trade or business. If that $50,000 loss comes to you as a passive investor, it can offset $50,000 of passive income. And if you don't have $50,000 of passive income, then it carries forward to the next year.
Yeah, that's huge. The carry forward is something to keep in mind.
Yeah, a lot of people don't understand. It's not use it or lose it. Whether it's a net operating loss because you're active, that net operating loss will carry forward indefinitely. So if you don't have income to offset that loss today, next year, if you do, it'll offset it. Same with passive losses. If you don't use passive losses today, it just goes into your war chest and you have that kitty that carries forward indefinitely. And so if I have $50,000 of losses that are passive this year and I don't use it, well, that $50,000 just carries forward to next year. If I have the same thing, now I've got $100,000 of losses that carry forward to the next year. And then in a year where you have a transaction, let's say you've got a $200,000 gain, well, I've got $100,000 of passive losses are going to offset that $200,000. I'll pay tax on $100,000. I'll have $100,000 that comes out to me tax-free.
And what would be an example of passive losses? I mean, is it just depreciation, or could you be in a real estate deal that went south and you lost your money? Are those all passive losses?
Correct. So there is anything that you don't materially participate. So really, you've got to look at the test, the material participation test. I don't do all the work. I'm passive. I don't spend more than 100 hours and do more than anyone else. I'm passive. I don't spend more than 500 hours in the deal. Passive. So if you don't materially participate, it doesn't matter if it's a car wash, if it's multifamily, if it's, provision. If you were passive in provision and we threw out losses because we, had a capital intensive year or we had a bad year, a downturn, that would be a passive loss. So that's really what it is. Most cases, losses in investments either come from capital investments, so depreciation, or going belly up. At that point, if it's an investment that is belly up and you're passive in it, if that deal ceases to continue, so it finalizes in that year and you have a passive loss, that passive loss actually does convert to an active loss.
Looking forward to the remaining portion of 2023 and the 2024 tax year, are there any major policy changes or potential major policy changes that are going to affect real estate investors?
Just bonus depreciation. There has been chatter about clawing back the IRA, the Inflation Reduction Act tax credits, the solar credits, the energy credits. So I know a lot of people were really gung-ho. I was really gung-ho about it, but there's, talked about clawing that back. So that could affect investors if people are looking to invest in deals that are putting solar on multifamily, things of that nature. Other than that, it really would be bonus depreciation and the fact that it's going from 80% to 60%. I think a lot of what you're seeing now that's not tax related, but will affect you from a tax perspective is leverage. Before it was 80% leverage and, or 70% leverage. So, on multifamily, if you're getting a 30% write-off in the first year and the deal's leverage 70%, every dollar you put into the deal, you're going to get $1 write-off. Well, now we're looking 50%, 55%. So if you put $1 into the deal and it's a 30% write-off in the first year, you're maybe only getting a 50-cent write-off on every dollar you put in that deal. So that's something to definitely plan for in the future.
What type of income will an investor be receiving from a partnership investment? Will it be ordinary capital gains, interest, dividend?
All of the above.
All of the above.
So it really depends. I mean, it depends where you are in the life cycle. If it's a deal that is actively being a business, then it's going to be ordinary income. Whether or not you materially participate in it will tell you whether it's active or passive. There might be reserves that a company has in a bank and it throws off interest. You might have a sale. So it might be in a year of sale. Well, in a year of sale, you have capital gains. So it just really depends on where you are in the life cycle of the deal and what the deal is investing in, or, ultimately what the deal is getting itself in income.
And does that stand for multifamily, triple net, any sort of real estate investments?
Correct. Anything during the life of a deal, it's a business. So it's going to throw off income that is going to be ordinary income or losses that are going to be ordinary income. At the individual level, you then test whether you materially participate in that. It's active. If you don't, it's passive. In the year of sale, you're going to have capital gains because hopefully capital gains or capital losses. You're hoping that that deal appreciated and therefore it's going to throw off capital gains when it sells.
And all these investments that we're creating with triple net and multifamily, are they all partnerships across the board or does it vary?
They should all be partnerships. You should never own any appreciating assets in anything but a partnership.
Tim, what's the difference in between a long-term capital gain and short-term capital gain?
Long-term capital gains are taxed at a preferential tax treatment. So 15% or 20%, depending on what level of income you have personally. Short-term capital gains are taxed at ordinary income. So, and the caveat, the difference is 1 year and 1 day. If you hold an asset for 1 year and 1 day, 1 year and 2 days, it's long-term capital gains. If you hold it for less than that, it is short-term. So that's the big differentiation between the two. Short-term ordinary income taxed at as high as 37%, long-term taxed at 20% at its highest rate.
If the general partnership issues a capital call, how is that handled for tax purposes? What are some of the ramifications?
So ultimately, a capital call is just you're putting capital into the deal. So you're just capitalizing that deal like you did when you initially funded that deal to buy an asset. So that's all you're doing. It's just increasing your tax basis in that deal. So it's not a taxable transaction as far as it's not going to create a loss. It's not going to create a gain. It's just you are putting more money into that investment.
Got it. Yeah, well, that wraps it up, you guys. Tim, thank you so much for coming on the show today to help us out with some tax questions with real estate, multifamily. We appreciate your time, and we'll look forward to having you on a future episode.
Yeah, definitely. Anytime.